Sunil Subramaniam joins in on the show right now. Sunil, what explains this kind of weakness? And would you say that this is perhaps redemption at some fund level which is causing this kind of weakness? Because if one analyzes Friday's data, both FIIs as well as DIIs were net buyers.
Yes, absolutely. See, basically, this is there's no redemption pressure at any counters as far as we can see. But what is happening is that fund managers who were consistent buyers are staying off. Because I think what has happened is that if you notice over the last 6 months, few stocks have actually taken the Sensex to all-time highs. And those valuations, because there was a certainty to their earnings stream, because there was a confidence that rupee weakening would help IT and pharma, and that a consumption story would help retail finance and consumer durable stocks, there was a flight to quality where these stocks, because of the visibility in earnings, they had gone up and the valuations had gone up very high. So naturally, with the panic which has set in with the whole fixed income space because of what happened over the last 2 days, these stocks, naturally, there is a little bit of a scare and there is a selling by very few people. But the fact is that there are no buyers. And that's what I would attribute it to more. So my thing is that I think fund managers are waiting because this is like a falling knife. So whatever you catch, you're likely to get, bleed from your fingers. So wait for a couple of days to see where the dust settles and then step in for fresh buying. So I would categorize this as an absence of buying, a caution from domestic fund managers who, mind you, are sitting in a lot of liquidity because SIP flows have been continuing to be strong. There are about 7,500 crores of SIPs every month that come in. So there is cash in the system. In fact, at Sundaram, we've raised an NFO of 1,000 crores in our services fund. It got allotted just yesterday. So we are sitting on 1,000 crores of cash, but we are not in a hurry to deploy right now because we'll just wait for the time being, see where this whole volatility cycle ends, and then we'll step in.
Sunil, if the so-called perceived sell-off is largely because of debt market issues, then why call rates have not shot up? How come nobody is taking comfort from the fact that today when I looked at the call market rates 1 hour ago and on Friday when I looked at the call market rates rates are not at some 15, 18, 20%. Even though this is the quarter end, call market rates are still in single digit.
Yeah, see, because this is not a liquidity-driven debt scare. This is a default and risk-rating-driven debt scare, no? Because if this was a liquidity-driven, what you would say would be true, that call markets would spike up. Right now, the system has liquidity. I think the scare has been created because one particular lender defaulted and fund managers in the debt side are forced to sell other good debt stocks in order to meet the redemption pressure. Because what I understand is a lot of institutions who have invested in debt products where, ILF's name appears, they are keen to redeem. So the redemption is on the debt side and hence other stocks are being sold. And because of this, there is an effect on the equity side. So this is not a liquidity-driven debt problem. This is more to do with the fact that will debt financing companies find it tough to raise fresh money? Would their rates go up? Borrowing costs go up? And hence, what would be the impact on their future earnings growth?
Okay, Sunil, we'll let you go, but it's kind of baffling.